Dear students, welcome to Commercial Subjects Group, Level 3, Accounting 213, Chapter 2. Today, we will explain inventories and cost of sales FIFO method under the Perpetual system. By the end of this lesson, you should be able to know the definition of Perpetual inventory system and the calculation of cost of goods sold and closing inventory by using the FIFO method under the Perpetual system. First, I will remind you of main points we explained last lessons. To start the lesson with, you need to know what does the word inventory means. Inventory is an asset that is intended for sale or to be used in producing goods. For many companies, inventory represents a large, if not the largest, portion of assets in the balance sheet. The need for inventory valuation. Keep in mind that there are more than one type of inventories owned by business companies, and this depends on the type of activities or operations those companies perform. For example, merchandising company, which purchases finished products and resells them to customers. Consider your local grocery store or retail clothing store. Both of these are merchandising businesses. So, in this case, the term inventory consists of goods purchased in their completed state. The second type of companies are manufacturing companies. A manufacturing business is any business that uses raw materials, parts, and components to assemble finished goods by employing machines, robots, computers, etc. One example of manufacturing business is cars manufacturing companies, such as Ford. So, in this case, the term inventory include raw materials, work in progress, and finished goods awaiting sale. The third type of companies are service companies. A service company is a business that generates income by providing services instead of selling physical products, such as bankers and accountants. For example, accounting companies hold very little, if any, inventories. So, in this case, the term inventory may include a balance of work in progress, which represents services provided but not yet billed. Definition of Perpetual Inventory System. Dear student, as you know, we have two inventory accounting systems that can be used. Can you remember what are they? Yes, periodic system and perpetual system. During the past lessons, I explained the periodic system. In this lesson, I will explain the perpetual system. So, what does the perpetual system means and how it is different compared with the periodic system? Businesses using a perpetual inventory system take a physical inventory count in real time, which means at the same time of transaction. For example, a grocery store. Each time a product is scanned and purchased, the system updates the inventory levels in a database. A perpetual inventory system will record changes in inventory at the time of the transaction and not only at the balance sheet date like the periodic inventory system. In this lesson, I'm going to explain for you the FIFO method under the perpetual inventory system. And here is an example of Abdelhadi company which uses a perpetual inventory system. The following information were generated from the company's records in May 2020. In 1st of May, The beginning inventory balance was 200 units at a cost of 25 BD per unit. On 8th of May, Abdelhadi Company purchased 300 units at a cost of 30 BD per unit. On 12th of May, the company sold 400 units at a selling price of 60 BD per unit, and so on for the rest of the month. Here is the idea behind perpetual inventory system. Every time the company has transactions like in the above table, whether it is sales or purchase, there is going to be an immediate update to the inventory account. For example, when the company purchases inventory, we are going to increase the inventory account. And when the company sells the inventory, we are going to decrease the inventory account. That's why it is called perpetual inventory system. That means we are perpetually or continuously updating the inventory account. In this example, you are required to compute cost of goods sold and cost of ending inventory using FIFO method, and then compute the gross profit. We will calculate the cost of inventory and cost of goods sold step by step. First, we will calculate the cost of beginning inventory by multiplying number of units by the unit cost, that is 200 multiplied by 25 equals to 5000 BD. The same goes for the cost of inventory purchase on 8th of May. On 12th of May, the company sold 400 units. So, here we have to calculate the cost of goods sold using FIFO method, which is first in, first out method. So we will start by the oldest inventory first, by multiplying the number of units by the unit cost. 200 units will be sold from beginning inventory at a cost of 25 BD. The other 200 units will be sold from inventory purchased on 8th of May at a cost of 30 BD. As I explained before, in perpetual inventory system, the inventory cost balance has to be updated after each transaction. So, the inventory cost will equal to remaining inventory units from purchases on 8th of May multiplied by unit cost, 100 multiplied by 30 equals to 3000 BD. We will continue calculating the cost of inventory and cost of goods sold for the remaining transactions, and step by step, we will continuously or perpetually update the balance of inventory cost and cost of goods sold. So, we will continue to calculate the cost of inventory on 19th May for the 400 units purchased by following the above steps. And in the same way, we will calculate the cost of inventory for the inventory purchased on 24th of May. On 28th of May, the company sold 250 units. So here, we have to calculate the cost of goods sold using FIFO method, which is first in, first out method. So the company will sell the old inventory first. Remember that there are 100 units remaining from inventory purchased on 8th May. So the company is going to sell it first according to FIFO method. The remaining 150 units sold will be taken from inventory purchased on 19th of May. So here we calculate the cost of goods sold in two steps by multiplying the number of units sold by the unit cost. Next, you need to update the inventory balance cost. The company has 250 units remaining in inventory from purchase on 19th of May and 100 units from purchase on 24th of May. Inventory cost for each will be calculated in the same way mentioned above. That is, number of units multiplied by unit cost. The final step is to find the total of cost of goods sold by adding the cost of goods sold on 12th and 28th of May for the total of 650 units sold. That is 5,000 plus 6,000 plus 3,000 plus 5,250, which equals to 19,250 BD. And the cost of ending inventory for the remaining 350 units is calculated as the total of 8,750 BD plus 4,200 BD, which equals to 12,950 BD. The second requirement is to calculate the gross profit, which equals to sales minus cost of goods sold, which equals to 22,000. Dear student, now I will explain for you another example from your book. So please open your student book on page 58. We will solve exercise number 4. Salman Company uses a perpetual inventory system. The following information were generated from the company's records in June 2020, and you are required to 1. Compute cost of goods available for sales. 2. Compute the number of units in ending inventory. 3. Compute cost of goods sold and cost of ending inventory using FIFO method. 4. Compute the gross profit. The first requirement is to calculate the cost of goods available for sale. And we mean by that to calculate the cost of beginning inventory plus the cost of all inventory purchases. Dear students, be careful here. Don't include the units sold on 14th and 27th of June. So, you need to multiply the inventory units by the unit cost in each date as shown in the table. And the total value for cost of goods available for sale is 39,500 BD. In the second requirement, you need to compute the number of units in ending inventory. To do that, you have first to find the total of beginning inventory units plus all units in inventory purchases during the month, which are 3,000 units, and then subtract the number of units sold on 14th and 27th of June, that is 1,200 plus 250 units. So, the number of units in ending inventory are 1,550 units. Next, you are required to calculate the cost of goods sold and cost of ending inventory by using FIFO method. We will calculate the cost of inventory and cost of goods sold step by step. First, we will calculate the cost of beginning inventory by multiplying the number of units by the unit cost. That is 800 multiplied by 10 equals to 8,000 BD. The same thing goes for the cost of inventory purchase on 9th of June. On 14th of June, the company sold 1,200 units. So here we have to calculate the cost of goods sold using FIFO method, which is first in, first out method. So we will start by the oldest inventory first, by multiplying the number of units by the unit cost. That is, 800 units will be sold from beginning inventory at a cost of 10 BD. The other 400 units will be sold from inventory purchased on 9th of June at a cost of 12 BD. As I explained before, in perpetual inventory system, the inventory cost balance has to be updated after each transaction. The inventory cost will equal to remaining inventory units from purchases on 9th of June multiplied by unit cost, that is 600 multiplied by 12 equals to 7,200 BD. We will continue calculating the cost of inventory and cost of goods sold for the remaining transactions, and step by step we will continuously or perpetually update the balance of inventory cost and cost of goods sold. So, we will continue to calculate the cost of inventory on 18th June for the 700 units purchased by following the above steps. And in the same way, we will calculate the cost of inventory for the inventory purchased on 23rd of June. On 27th of June, the company sold 250 units. So here we have to calculate the cost of goods sold using FIFO method, which is first in, first out method. So the company will sell the old inventory first. Remember that there are 600 units remaining from inventory purchased on 9th of June. So the company is going to use it according to FIFO method. So the cost of goods sold will be calculated by multiplying 250 by 12, which equals to 3,000 BD. Next, you need to update the inventory balance cost. The company has 350 units remaining in inventory from purchase on 9th of June and 700 units from purchase on 18th of June and 500 units from purchase on 23rd of June. You will multiply each one by its unit cost. The total cost of ending inventory is 23,700 BD for 1,550 units remaining in inventory. The final step is to find the total of cost of goods sold by adding the cost of goods sold on 14th and 27th June for the total of 1,450 units sold. That is 8,000 plus 4,800 plus 3,000, which equals to 15,800 BD. The last requirement is to calculate the gross profit, which equals to sales minus cost of goods sold. First, you need to calculate sales in BD by multiplying units sold by selling price. Refer to the data provided in the table. The total sales will equal to 29,000 BD. After we calculated the sales, we take cost of goods sold calculated earlier in the table in requirement 3. We are ready now to calculate gross profit, which equals to 13,200 BD. Dear students, we reached to the end of this lesson, and you should have achieved the lesson objectives. Thank you very much for your attention. Kindly refer to the student book and EduNet. Read the lesson again and practice with more exercises. Good luck.